We're jumping straight into Coinbase Global today. Everyone is watching the price action, but the real story is the everything exchange strategy.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get rolling here, do us a quick favor, just hit subscribe and tap that like button. It really helps us grow the show and, frankly, keeps you ahead of the curve.
Definitely.
So look, we have to talk about what happened yesterday, February 25th. I mean, I was watching the ticker, and it wasn't just moving. It was absolutely ripping.
It was a monster day.
Yeah, up over 13.5% in a single session. But honestly, it wasn't even the price that caught my eye. It was the sheer volume of money changing hands.
Right. The volume is what told the real story there. We saw $4.2 billion in trading volume.
Which is just a massive number.
It is. And just to put that in perspective for everyone listening, that wasn't just a busy day for a crypto stock. That was the 16th highest trading volume day among all equities in the entire market yesterday.
Wait, all equities? That's bigger than most of the Magnificent Seven on a typical day.
Precisely. And when you see liquidity like that, it tells you something very specific. That isn't just retail traders, chasing a green candle because they saw a meme on social media.
Right. Retail doesn't move $4 billion.
Exactly. That represents serious institutional accumulation. That's big money. Pension funds, hedge funds, moving into positions, they are voting with their wallets right now.
So if the big money is piling in like that, what was the trigger? Like, what actually changed yesterday that didn't exist the day before?
The catalyst is crystal clear. It's their official launch of zero-commission U.S. stock and ETF trading, complete with 24/5 market access. Yeah, this is the exact moment the market decided to stop treating them as just a crypto exchange.
Okay, let's unpack that. Because for as long as I followed this company, the narrative has been painfully simple. Bitcoin goes up, you buy the stock. Bitcoin crashes, you sell the stock.
Yep.
It's essentially been treated like a leveraged bet on crypto prices.
The classic crypto casino narrative.
Right.
And it's been true for a long time. But yesterday was a fundamental repricing event. The market is finally looking at them and seeing a diversified fintech platform.
So investors are saying this pivot into traditional stocks and ETFs actually reduces their risk profile.
Exactly. If crypto goes into another winter, they now have a traditional brokerage business to keep the lights on and keep users engaged.
It feels like a massive psychological shift for the company. They aren't just playing defense anymore, trying to survive until the next Bitcoin happens.
No, this is pure offense.
Yeah, they are coming directly for Robinhood's lunch.
They absolutely are. And if we're going to really understand the bull case here, we have to look at this everything exchange strategy. They aren't staying in their lane.
Not at all.
They're challenging the status quo. You mentioned Robinhood, and that is the key comparison, but there's one specific partnership involved in this rollout that I think completely changes the game.
You're talking about the integration with Yahoo Finance.
Yes. And I honestly think people are underestimating how significant this embed is.
I mean, I have to be honest, I still use Yahoo Finance every single morning. It's just a habit I can't break. I check the pre-market movers, look at the charts. It's where I go.
You and millions of other people, it's essentially the default homepage for retail investors. But think about your workflow right now. You see a stock on Yahoo you like, you read the earnings report, and then what do you do next?
Well, I have to open a new tab or grab my phone, open my brokerage app, do the Face ID thing, find the ticker again, and then finally place the trade.
Exactly. That is friction. And in the world of app design and consumer tech, every extra click loses you a massive percentage of users.
True.
What Coinbase has done here is embed their execution engine directly into that Yahoo research platform. So now the workflow is, you see the trade on Yahoo, you click buy right there on the screen, and Coinbase executes it in the background.
That is incredibly slick. So they're basically camping out right where the intent is actually generated.
They're capturing the user at the exact moment of decision. And when you combine that seamless experience with zero commissions and 24/5 trading,
you realize they're building a machine designed to capture retail attention exactly when it's highest.
Exactly. And remember, they're doing this with a user base that is already highly comfortable with volatility and active trading.
Okay, strategically, I get it. It's a brilliant trap for capturing volume. But strategies are cheap, right? Execution is expensive.
Very true.
Building a stock exchange from scratch isn't free. Does the company actually have the financial fortitude to pull this off? Or are they just burning cash to chase a trend?
That's the right question to ask. If you look at the financials from 2025, the picture is incredibly robust. We aren't just talking about a concept here. We're talking about a company that is printing cash.
Let's hear the numbers.
In 2025, their total trading volume grew 156% year over year.
Wow.
That is explosive growth by any metric.
It is huge top-line growth. But as an investor, I always worry about the volatility there. If trading completely dries up, does all that revenue just evaporate?
That's why you have to look at the subscription and services line item. This is the boring, recurring, stable money. We're talking custody fees, staking rewards, stablecoin interest.
The sticky revenue.
Exactly. That revenue stream rose 13.4% to over $727 million.
That's a serious cushion.
It's nearly $750 million in recurring revenue that comes in, regardless of whether the market is manic or totally depressed.
Okay, that definitely provides a nice floor. But what about profitability? Usually when tech companies make a massive pivot like this, their margins get completely crushed because they're spending so heavily.
This is where the numbers get really interesting. Their last 12 months gross margins are sitting near 85%.
Wait, 85%?
Yes.
That sounds more like a pure software company than a traditional financial brokerage.
Because that's the beauty of their model. It is software economics. They run a highly asset-light model. They don't have thousands of physical brick-and-mortar branches. They don't have an army of financial advisors on the payroll.
Right.
Once they build the platform infrastructure, the cost to onboard the millionth user is virtually zero compared to the first. That 85% margin gives them incredible operating leverage.
So for every extra dollar of revenue they bring in, a huge chunk flows straight to the bottom line.
Yeah.
Their EBIT margins are around 30%, right?
Thought on, around 30%.
So they definitely have the cash flow to fund this war with Robinhood.
Oh, absolutely. Operating cash flow was $2.4 billion in 2025. You could easily call that a fortress balance sheet. They aren't just surviving, they're generating a massive war chest.
And that war chest lets them survive those brutal crypto winters that wipe out the smaller players. Okay, so they have the money and they have the tech. But let's play devil's advocate for a second. Robinhood is already established. Fidelity is established. Schwab is established. Why would anyone actually switch?
It's a fair point.
Robinhood has a cult-like following. Why would a 22-year-old day trader bother moving their entire portfolio just because Coinbase added stocks?
It comes down to two things: trust and convenience. First, on the trust side, let's be honest, crypto has had a massive reputation problem over the last few years.
To put it mildly.
Right. We've seen exchanges blow up, founders go to jail, but Coinbase has actively positioned itself as the adult in the room. They are the largest registered crypto exchange in the U.S.
They have the regulatory credibility.
Exactly. They have the licenses, the institutional trust. They've played the long game with regulators while others cut corners.
So for the person who is maybe a bit nervous about the Wild West of crypto, Coinbase feels like a safer harbor.
It's the flight to quality. But the second factor, convenience, is really about the cross-selling flywheel. Think about their existing user base. They have millions of users who originally signed up just to buy a little Bitcoin or Ethereum.
Right.
Those users already have funds settled in that ecosystem. Right now, if they want to buy NVIDIA or Tesla, they have to sell their crypto, transfer the money out to a traditional bank.
Wait for it to clear.
Wait 2 days for it to clear, send it over to Robinhood, wait again, and then finally trade.
Which is a massive pain. Nobody likes waiting for funds to settle.
It's terrible UX. Now, they can just sell a fraction of a Bitcoin and buy Tesla instantly without ever leaving the app. It consolidates their entire financial life. And look at the competition. Robinhood has lost approximately 35% so far in 2026.
Ouch. Why the massive drop for them?
Because Robinhood is heavily exposed to drops in crypto trading volume, but they don't have the same institutional backbone or the depth of crypto products to winter it.
Yeah.
Coinbase is using this diversification into equities to outperform during those exact same crypto downturns.
It sounds like a really solid plan. And looking at the forward guidance, analysts are expecting a 12% compound annual growth rate in revenue over the next 2 years.
Which is very steady.
But I have seen some headlines lately about their earnings per share, their EPS being under pressure. Should we be worried about that?
You really have to look at the context there. If you see earnings per share dip, you always have to ask why. Is the underlying business breaking, or are they just investing heavily?
And in this case,
It's clearly reinvestment. Launching a full-scale U.S. equities brokerage, building out that Yahoo Finance integration, setting up 24/5 trading infrastructure, that stuff is expensive.
yeah, that's not cheap.
Not at all. They are spending heavily on tech and marketing to aggressively capture market share right now. It's a calculated bet. They are willingly sacrificing short-term EPS for long-term dominance.
Okay, that makes sense. So that's a pretty comprehensive bull case. They are executing this everything exchange pivot. They have a fortress balance sheet, and they are stealing market share. But let's look at the flip side.
Let's do it.
Because as exciting as this pivot is, there are real risks here that we absolutely cannot ignore. What breaks this thesis?
Well, the biggest one is the reality check on their core business.
Risk number one, the crypto tether. We can talk about stock trading all day long, but isn't the reality that their earnings are still massively sensitive to Bitcoin and Ethereum prices?
That is the ultimate reality check. You simply cannot decouple a massive company from its core revenue driver overnight. We've seen a pretty brutal pullback in Bitcoin recently. It's been all over the news.
Yeah, it's been a rough few weeks.
And when crypto prices drop, retail interest fades, and those high-margin transaction volumes just dry up. If that happens in Q1 2026, all the zero-commission stock trading in the world might not be enough to offset the loss in crypto fees.
Because, just to clarify, crypto trading fees are generally much higher than stock trading fees, right?
Exactly. Stock trading has been a race to zero fees for years. Crypto trading still commands a significant premium. So if they lose the high-margin crypto volume and just replace it with low-margin ETF volume,
Their overall profitability takes a major hit.
precisely. And we actually saw warning signs of this recently. Their operating cash flow dropped nearly 22% year over year.
That's a significant dip.
It is. And it reminds you that this is still, at its core, a highly cyclical business driven by crypto market cycles and heavy spending. If we enter a prolonged bear market, that cash flow number is going to look pretty ugly, regardless of the new equities features.
All right, so that's the macro crypto risk. Then there is risk number two, the regulatory headwinds. We talked about the regulatory moat earlier, but that certainly doesn't mean they are completely in the clear.
Not by a long shot.
I keep hearing about this Clarity Act in the news. Can you explain what that actually is and why it matters so much for their valuation?
So the Clarity Act was supposed to be the landmark legislation that finally gave the U.S. crypto industry a clear rulebook. It would explicitly define what constitutes a security versus a commodity, specifically for things like crypto derivatives and stablecoins.
It was supposed to end the whole regulation by enforcement era with the SEC.
Exactly. It would provide regulatory certainty.
And what's the current status of it?
Not good at all. If you look at the prediction markets right now, like Poly Market, the odds of this act actually passing in 2026 are declining rapidly.
And traditional markets absolutely hate uncertainty.
It's a major overhang. Without that act passing, the regulatory environment for their highest growth areas, like derivatives, remains totally gray. And on top of that, the SEC scrutiny hasn't just vanished.
Right, they're still looking at staking, aren't they?
Exactly. There's ongoing scrutiny regarding their staking products. And remember, staking is a huge part of that stable subscription revenue we liked so much earlier. If the government decides to crack down there, it would be a massive blow. The regulatory fight is far from over.
Definitely something to watch. And finally, risk number three is just pure execution risk. It sounds amazing on paper, the everything exchange. But can they actually pull it off? Q4 2025 was actually a bit soft, wasn't it?
It was. Transaction revenue saw some declines.
So that soft quarter is a bit of a warning sign.
It shows they aren't immune to gravity. And frankly, the competition here is fierce. Racing against an entrenched player like Robinhood is incredibly expensive. Ultimate success depends on whether retail users actually switch platforms or just stick with what they already know.
Because people are inherently creatures of habit.
Exactly. Just because Coinbase offers Apple stock now doesn't mean a Robinhood user is going to go through the hassle of moving their entire portfolio over. If they build this massive everything exchange infrastructure and nobody actually comes over from the traditional brokerages, they've just spent billions for very little real growth.
That is the multi-billion-dollar question. Is the grass actually greener on their platform? Okay, so we've laid out the bull and bear cases. Now let's talk about what we actually need to watch. If I'm holding this stock or if I'm on the sidelines thinking about buying it, what are the specific dates on my calendar?
There are three main catalysts I'm watching very closely over the next few months. Catalyst 1 is their Q1 2026 earnings report, which should drop in late April.
Aside from just the top-line revenue beat or miss, What metrics matter most in that report?
I'm looking past the headline numbers. I want to see the specific adoption metrics for this new equities trading. Are people actually using the Yahoo Finance integration? Are we seeing user growth accelerate because of the stock offerings?
Because a beat on those specific adoption metrics completely re-rates the stock.
Exactly. It proves the thesis. But if the uptake is slow and the everything exchange narrative looks like a dud out of the gate, the stock will get punished.
Makes sense. What is catalyst number 2?
Tokenization and real-world assets, or RWA. We expect this to really show up in the first half of 2026.
Okay, we hear tokenization thrown around a lot in fintech circles, but let's break that down for the listener. Why is this a real catalyst for Coinbase and not just another crypto gimmick?
Think of it like the difference between sending a physical letter and sending an email. Right now, when you sell a stock on a traditional exchange, it actually takes 2 full days, what the industry calls T+2, for the trade to truly settle and the cash to be yours.
Right, because the plumbing of the traditional financial system is ancient. There are clearinghouses and middlemen confirming everything.
Exactly. Tokenization means putting those traditional assets, stocks, bonds, real estate, directly on the blockchain. It allows for instant 24/7 settlement. It completely removes those middlemen, which saves billions in fees and frees up capital that is usually just stuck in transit.
And Coinbase is actively exploring tokenized stocks and RWA perpetuals.
Yes.
RWA perpetuals. That sounds incredibly complicated.
It's basically a way to bet on the future price of a real-world asset, like a barrel of oil or real estate, without actually having to own or store the physical asset and doing it entirely on the blockchain. Analysts are actively predicting a tokenization supercycle beginning in 2026.
Wow.
We are talking about tapping into a multi-trillion-dollar market here. If Coinbase positions itself as the bridge that brings trillions of dollars of real-world assets onto the blockchain, that is a massive structural unlock for their valuation.
So it's basically digitizing the entire world's financial assets to make them faster and cheaper to trade.
Exactly.
Huge potential there. And finally, catalyst number 3 is the macro picture.
It always comes back to macro. You have to keep a close eye on the Federal Reserve, particularly looking ahead to the second half of 2026. The market is constantly sniffing around for potential rate cuts.
And lower rates are usually a risk-on signal, right?
Lower rates are rocket fuel for risk assets. When interest rates are high, you can get 5% just sitting safely in cash, so why take a risk? But when the Fed drops rates, that money goes looking for yield. It flows heavily into high-growth tech stocks, and it flows into crypto.
And Coinbase sits perfectly at the intersection of both of those worlds.
Exactly. A dovish Fed in H2 2026 would be a massive tailwind for both sides of their diversified business.
All right, so let's wrap this deep dive up. What is the final lowdown here? We have a company that is making a very high-conviction pivot. They are actively trying to evolve from a pure crypto exchange into a unified everything exchange platform.
That is the core thesis. They are leveraging that fortress balance sheet and their hard-won regulatory trust to directly attack the traditional brokerage market.
And the valuation implications are staggering. Right now, the market cap is hovering around $100 billion.
Right. And if they actually execute this strategy, if they successfully combine zero-commission stocks, crypto trading, and this coming wave of tokenization, the argument is that this company shouldn't be valued like a niche exchange anymore.
It should be valued as global financial infrastructure.
Exactly. If they pull it off, we could potentially see the market cap double, going from 100 billion to 200 billion plus over the next 12 to 36 months.
But as we discussed, that if is doing a lot of heavy lifting.
It really is. It requires flawless execution against fierce competitors. It requires favorable regulatory clarity. And most importantly, it requires a user base that is actually willing to consolidate their entire financial life onto this one platform.
Well, here is the final provocative thought I want to leave you with today. The market has priced this company as a pure crypto exchange for years. When Bitcoin moved, they moved. But now they are offering you a traditional brokerage account but with a massive crypto supercharger attached to it. So the real question for you as an investor is, are you ready to value them as a traditional brokerage? Because if you are, the valuation multiples look very, very different going forward.
That is the perfect way to frame it. It's an identity crisis for the stock, but potentially a very profitable one if you get the timing right.
Absolutely. Thanks for joining us for this deep dive. We'll catch you on the next one.